Hey, listen, I'm typically a non-violent kind of guy, but today, pop, I'm gonna sock it to you. I'm gonna give you 10 finance terms. I want you to know because you're probably gonna see them where? Yeah, on that state exam. In fact, you know what? I want you to know them for the rest of your real estate career. Here it goes. Let's start off big. Let's go with the term beneficiary. Ooh, the word beneficiary, what is it? Ready? Let me set the table for you. You have a borrower, walks into the bank, says, hey, bank, I'd like to borrow some money because I want to buy my house. Bank says, sure. Bank does all their research. They say, yep, here you go. Here's your money. But before we give you the money, I want you to sign what's called a trust deed, the promissory note. And that's you, Mr. Borrower, promising to give us back our money to make payments to us. Got it? You got the lender, you got a trustee, and you got the borrower. In this particular situation, of those three, which one is the beneficiary? Anytime you hear the word beneficiary, I want you to think of the lender. The lender in this scenario is the beneficiary. They're gonna benefit from you paying the interest. You got it? Next one is equity. Equity, what is equity? You buy a house for $750,000. $750,000. Over a couple of years, the value of the house goes up. The value goes up to $1 million. Now, equity, here's the formula. The difference between the value of the house, which is $1 million, and what you owe on the house. The difference, in this case, is $250,000, $250,000. That's good, that's fantastic, that's equity. In the long run, the value of this home will increase, which means in the long run, you're adding more and more and more what? Yeah, adding more equity. Now here's the kicker. It's not liquid funds, but when you cash out, when you sell the property, it's a lot of dough going into your bank account if you have equity. Now let's go to the next one. The next one is FHA, that acronym FHA. Now let's start off with the acronym itself and what does it mean? What does it stand for? It stands for Federal Housing Administration. Now, the Federal Housing Administration is a part of the HUD department, the government's HUD department. What does HUD stand for? Hell, that's a bonus one. What does HUD stand for? Housing of Urban Development. Now, what FHA does is this. Here's the key factor. The FHA department insures loans for people who want to buy property. Listen, it gets a little sticky, so let me clarify. It insures loans. It does not give loans. Let's start off nice and slow with FHA. It started in 1934. Now, what was happening in 1934? If you're a history buff, what was happening in 1934? Yeah, I'll wait. Yeah, the Great Depression, right? So what the government wanted to do was they wanted to stimulate the economy, so they came up with the FHA program. Now, the FHA program is extremely beneficial for buyers because it only requires a very small down payment. In fact, today's down payment for the FHA program is only 3.5%, which is incredible. The interest rates are very reasonable. It's a great way for first-time buyers to get involved in home ownership. Now, the great thing about the HUD program is that your credit score doesn't have to be the best. In fact, today's criteria is your credit score only has to be a 580. Think about that, a 580, which is fantastic. Let's dive deep a little bit about the FHA program. I want you to know how this works. FHA says, hey, lender, hey, bank with money. How about you lend money to the borrower over there? And if they default, if that borrower defaults, Mr. Lender, we'll pay up. We'll cover their debt. We'll insure the loan. Lender's gonna say, well, hell, we got nothing to lose. What a great idea. Sure, we'll take part in this party. We want in. So what the FHA program does is it charges the borrower a monthly fee called mortgage insurance. And that small fee of mortgage insurance will insure that loan. So the lender has no fear that they're gonna lose out. Hey, I'm gonna give you a double on this one. Pop, pop, here it comes. A combination. We're gonna go liens, but not just any lien. We're gonna go general lien, and we're gonna go specific lien. Let's start off with general lien. I want you to know what a general lien is. Now, a general lien is when a creditor, let's give you an example, a creditor of, I don't know, the US government, you didn't pay your taxes. It's when a creditor, in this case, the US government, good old Uncle Sam says, we're coming after your property. We're coming after all of your assets. And they can. They'll put a lien on all of your assets. Nothing specific. If you got 2 houses, they'll go after 2 houses. Bottom line is they want your stuff. They want your money because you owe them big time. It's a general lien. How about a specific lien? Completely different. A specific lien. I want you to know this term, a specific lien. It's specific to what? Yeah, one property. A specific lien. You buy a property. You get a mortgage on the property. Now that mortgage is specifically, yeah, specifically, it's specific to that one property. That's a specific lien. A mechanic's lien. A mechanic's lien. Somebody puts a pool in your backyard and you don't pay up. They put a pool on a property located at 1234 Main Street. You don't pay up, they're gonna put a mechanic's lien. On what? Yeah, 1234 Main Street. That's a specific lien. Now, hope you're enjoying these finance terms. I sure as hell am. Listen, lighten up, not a big deal. We're gonna make them crystal clear again. Here we go, nice and soft. Let's go to the next one. Acceleration clause. You like that, huh? Acceleration clause. I want you to shorten that keyword of acceleration to accelerate, which means what? Yeah, to speed up. Ready? Here comes the example. When a borrower borrows money from the bank, they sign a whole bunch of paperwork. And many times there are clauses in there. In the acceleration clause, it's the bank's way of saying this. Hey, borrower, don't forget, you promised to pay us back every single month. Now, the minute they miss that first payment, they might get a knock on the door, so to speak, from the bank saying, yo, remember our deal? Which included that promissory note that said you would pay us every single month, and if you don't, we have the right to request all monies due at once. We have the right to accelerate the payment, the whole thing. Whatever is due, we want it like now. Now, of course, the bank typically won't say, after a month of being late, give us our money. We want out of this relationship. Typically, they'll give you 2-3 months, and if you can't, what they're gonna do is they're gonna, foreclose on you. If you can't satisfy that acceleration clause and pay up, they're gonna say, well, the only other remedy we have as a lender is to forcefully take back our house through the law. And that's called foreclosure. All right, next term when it comes to finance, hope you're enjoying this, is gonna be the term underwriting or underwriter. Ooh, the underwriter, one of my favorite topics. Now, who is the underwriter? What does he do when it comes to underwriting a loan? Borrower is excited, they want to buy a house. They walk into a bank gives them a cup of coffee and they chit chat, huh? The buyer provides them with documentation. They review the documents. They say, yes, you qualify for a loan, go find yourself a house for $1 million. They look all over the city. They find the best house that's appropriate for their family. Offer gets accepted. They open escrow. Ooh, now things are getting serious, huh? Now this is where the bank really gets heavily involved because the bank wants to do two things. They want to be happy and satisfied with the borrower's qualifications, and believe it or not, they want to be satisfied with the property's qualifications. And that's where the underwriter comes in. The underwriter's job is to consider the risk involved here. So they're gonna review all the documentation for this borrower. Everything. They wanna be super satisfied, the underwriter does, that this guy qualifies. Whoa, we're not done yet. They also wanna qualify and make sure that the property that was selected, if it's an FHA loan, ooh, this house has to qualify. They wanna make sure that this property that they're going to be using as collateral doesn't have any safety or health conditions with it. So they wanna qualify both the borrower and the property. So who does all of this? That underwriter that nobody sees, the mystery person. Nobody gets to meet this person, but they're back there in that back room and they're doing some major research on both the borrower and the property to make sure that the risk is as minimal as possible. All right, let's continue to rock and roll. Here we go. The next term is hypothecation. Might be new to some of you. Hypothecation, you're gonna see this, I guarantee it. So what is hypothecation? It's actually a way of owning property. An agreement, hypothecation. Ready? Here it comes. Borrower walks into the bank, wants to borrow money to buy their property. In a nutshell, the bank says sure, and they qualify, and it's done, it's a done deal. The homeowner now bought his property with the bank's money. Now, per hypothecation, this property they just purchased using the lender's money is going to be collateral. For who? Yeah, the bank. And the bank is saying, yo, house, homeowner over there. Yeah, that's your house. Sure, you can paint it purple if you like, for all we care. Do what you want with it. But don't forget, we're the lender. And that house that you're living in is collateral for the loan. And if you don't pay up, we're allowed to take it back via foreclosure. But in the meantime, while you're living in it, making your payment, it's all yours. All the equity that you gain from owning the property, you get to reap the rewards, Mr. Borrower. You don't have to give us a dime of your equity. That's hypothecation. Hypothecation, we'll lend you the money as long as you make your payments back to us. We're on good terms. You get to enjoy the home ownership. You get to enjoy the equity. You get to enjoy the bundle of rights. All right, let's get straight to the next one. Debt to income ratio. So what is debt to income ratio? It's a way for a bank, for the lender to see if a borrower qualifies based on their debt and based on their income. Now somebody may make tons of money. They have a great salary. They make $1 million a year. Ooh, big shot, nice. But along with that, they may have tons of what? Yeah, debt. That almost eliminates the possibility of purchasing a property Because they have too much debt. So where is the criteria? What percentage are we going to allow them to have debt when it comes to their total income? Let's assume somebody makes $10,000 per month. $10,000 per month, not bad. And their debt per month is $3,000. We're talking the mortgage, we're talking their car payment, we're talking, I don't know, alimony, all the debt they have is $3,000 a month. The debt is 30% of their income. Now, based on the bank's criteria, based on that number, 30%, they'll say, yeah, you qualify, or no, you don't. The debt to income ratio. Now, let's finish off nice and simple, huh? Fixed rate loan. A fixed rate interest rate. You go to the bank gives you a cup of coffee, you chit chat, you want a loan. You want to borrow some money because you want to buy a house. Bank says you qualify for $1 million. Boom, done. Bank says you want a fixed rate or you want an adjustable rate. You say, I want a fixed rate. Fixed means it's not going to change. Fixed means it's going to remain the same for the length of the loan. Let's assume it's a 30-year loan and the bank is promising you 4% interest rate. Well, guess what interest rate you're going to have on year number 29? 4%. Throughout the duration of that loan, that 4% remains the same. It remains what we call fixed. Why is a fixed rate beneficial? Well, it's because the borrower can pretty much predict their payment. The only thing that'll throw off this payment will be the taxes. Hey, listen, I just gave you 10 terms, 10 financial terms that you probably thought you'd never understand. Listen, I loved you throughout this video, and I wanted to present them to you in a way that you're gonna get it. I'm sure you got it. Now listen, you're also gonna need to know these for the rest of your real estate career, man. Share them with your clients. Let them know that you're knowledgeable when it comes to this real estate industry. And listen, watch this video here. Get some more study support with this video right here. It'll help you out tremendously. We'll see you next week.